All eyes were glued to Nvidia Corporation as they reported their Q4 results after the market closed. The highly anticipated print is finally here. It's in our hands. We're going to comb through it for you. We'll go through the numbers and the expectations, not just for this most recent quarter, but I'd say the more important upcoming quarter over at Nvidia. We'll take a look at things that are sliding and slipping over at this company. Spoiler alert, it's the gross margins, not really the growth rates, but the gross margins. We're also going to take a look and talk about some of the comments made by Jensen Huang on the conference call, talk about some of maybe news stories coming up with Nvidia as it relates to export controls over in China. And then of course, we have to take a look at the financials that we know are relatively good, but we'll still take a look at those once more. Technically, you are basically chopping sideways. You aren't really moving around with this one in the after hours as well. We'll see what that means. Maybe some sideways consolidation for Nvidia is actually a good thing, considering the fact that shares are up nearly 66% over the past 1 year. Hey guys, hope you're doing well out there. You have a $3 trillion market cap on shares of Nvidia. The forward earnings multiple, while it looks kind of expensive here on Seeking Alpha at 42 times, keep in mind this is still taking a look at the most recent calendar year that we are just closing up. And as you look forward over at Nvidia, the earnings multiple comes down drastically. And I say drastically because the growth rates over this company continue to be staggering. And speaking of those growth rates, we got that data center print of nearly $35.5 billion in the most recent quarter that did beat expectations. And even quarter over quarter, that was nearly a $5 billion jump, almost a $5 billion jump, not quite, closer to $4.8 billion just quarter over quarter. And that's really the run rate Nvidia has been on over the past number of quarters. You see, they like to add on about $4 billion on a quarterly basis to their top line on the data center business. That actually accelerated in the most recent quarter at nearly $5 billion added on a quarter over quarter basis. I mean, if you compare it over the past 1 year, it's tough to even compare this company year on year to itself. Now, what you did see slippage in is on the gaming side, as revenues went from $3.3 billion, call it down to 2.5 on a quarter over quarter basis. Even year over year, though, you are seeing revenue slip, as last year we were closer to $2.9 billion on that gaming side. But again, all of that and more has been already made up through the data center business. What you are quietly seeing very fast growth in is on the auto side, as you're seeing revenues nearly double year on year. As last year you were at $280 million, now you're at nearly $570 million from a revenue run rate. So while $570 million is still very, very small compared to nearly $40 billion of overall revenue, keep in mind the growth rates on that auto business is accelerating quite nice. We'll also take a look at the earnings call, as Jensen made some comments about the auto side of the business. But all things considered, you again added on nearly $4 billion to your total revenues, meaning your Q4 revenues came in at $39.3 billion. That was good for 78%. Yeah, that's right, 78% growth on a year over year basis. And that did beat expectations by about $1 billion. Now, keep in mind, Nvidia is known as the company that comes in with a beat of close to $2 billion, and they nearly raise revenue expectations by $2 billion. Well, that didn't quite happen in this quarter, and that's, I think, the main reason why you're not seeing shares pop in the after hours. Certainly, you're not seeing shares drop either, but because you didn't get that $2 billion beat and $2 billion raise, you're not seeing those same buyers get excited now that Nvidia is just posting a $1 billion beat and a $1 billion raise. And as expectations were closer to $42 billion for the current Q1 that we are in, Nvidia is guiding for revenues to come in at $43 billion. So again, you're not getting that $2 billion raise, you're just getting a $1 billion raise. And look, when expectations are so high for you, when your stock is up 66% over 1 year, up over 1,800% over the past 5 years, well then if you just come in with a $1 billion beat and a $1 billion raise, maybe, just maybe, it's not good enough after a certain point. The other, in fact, the most concerning thing from my perspective for this name at the current time is the slippage on your gross margins. And this is something to actually pay attention to very, very closely. So Nvidia is saying that they're guiding for GAAP gross margins to come in at 70.6%. On a non-GAAP basis, that'd be roughly 71% plus or minus 0.5%. So even if you give them credit for 71.5% gross margins, well, something I want to point out is in the most recent quarter, they posted non-GAAP gross margins of roughly 73.5%. And even that is sequentially down roughly 1.5 percentage points. So this company is guiding for the fact that GAAP gross margins, even non-GAAP gross margins, will once again be sequentially down somewhere between 1.5 to 2 percentage points. And year on year, you're seeing that slippage. Sequentially, you're seeing that slippage. And so the question is, when will the gross margins bottom and what will they bottom out at? Now, we do know Nvidia is ramping up Blackwell. They're trying to meet production and trying to meet manufacturing demands as fast as they can. And anytime you're ramping a new product, you tend to take a hit on your gross margins. But keep in mind, Nvidia will pretty much always be ramping a new product. If it's not Blackwell, it might be Blackwell Ultra. After that, it'll probably be Rubin. And so keep in mind, the gross margins may not actually ever get back up to the 77, 78, maybe even 80% gross margins, considering the fact that they'll always be in a ramp up phase for the next and newest and greatest chip that's out there. And so that's something to keep in mind. The question really lies is where and when do gross margins bottom out? Will it be underneath 70%? Will it be closer to 65%? And so on? And is competition really hurting the fact that gross margins are declining? So those are some questions you have to ask as it relates to Nvidia. But keep in mind, look, 70% gross margins, there's still pretty much every other semiconductor company out there that would die to have even 70% gross margins. We've taken a look at AMD. They're nowhere near this. Pretty much any other designer of chips, including Intel, nowhere near this. And so despite the slippage on your gross margins, Nvidia is still in a very, very lucrative position to be in within the semiconductor industry. Now, again, we talked about that $43 billion guide that Nvidia is doing for Q1. Again, that's higher than what Wall Street anticipated, not as quite high as the high end. That would have been closer to 47. Look, if Nvidia came in with a number even closer to $45 billion, I think that would have been enough to send shares meaningfully higher, considering the fact that it seemed like Wall Street was just now beginning to catch up to what the expectations should be for Nvidia, and the fact that the stock really hasn't moved over the last 6 months. I think anything closer to 45 would have certainly sent shares meaningfully higher. But the question still remains in Q2 and really in Q3 and Q4, will Nvidia be able to come closer to the high end of the estimate? Certainly in Q3, if they can put up a number closer to $55 billion, again, let alone closer to $60 billion, well, then there's your upside with Nvidia, depending on how Blackwell ramps. And look, we've heard from all of the hyperscalers, all of the cloud providers, that the demand is certainly there for their cloud products, which is why they're spending so heavily on Nvidia data center chips. Well, if in the back half of the year, TSMC is able to meet the demand that Nvidia is asking from them, and if Nvidia is able to deliver nearly all of those Blackwell chips to their customers, well, then I certainly believe they can get closer to the high end of the estimate, even north of $55 billion. And again, same story for Q4, the back half of the year, that's calendar year 2025, fiscal year 2026 for Nvidia. If the back half of that year can be really, really strong, well, then the stock still, believe it or not, has room for upside, considering the fact that, again, shares haven't done much over the past 6 months and the valuation really isn't that demanding. Now, one of the reasons this video is coming to you a bit later is because we were waiting for the conference call. And one thing about the conference call, look, Nvidia, if you're listening, you have to fix your mic. Look, my mic isn't great here on the channel, but I'm not a $3 trillion company. You certainly can do better and have a better quality mic for your conference calls. Now, one thing they did mention was that new models, that's new large language models, require more than 100 times more compute per task than one-shot inferences. And Blackwell was designed specifically for this. Eventually, they see that scaling up to thousands of times more compute per task, and then eventually millions of times more than today in the future. And again, that's just scaling laws. As compute gets more intensive, they're going to require more and more high intensity chips. And so while you could see this as a benefit for Nvidia, you could also maybe connect the dots. This could be beneficial for TSMC as they continue to bring down their silicon to 3 nanometers and 2 nanometers. They'll continue to have to innovate. Also, you can probably also connect the dots to ASML. Basically, any company in the semiconductor chain that has very, very strong technology, very, very strong intellectual property, and has qualities about it that other companies can't reproduce. Well, this basically tells you that the demand for those products will continue to be very strong, and it'll be harder and harder for other companies that are falling behind to catch up on these sort of products. And Nvidia also said despite the outrageous prices, they were able to improve productivity and improve costs for their customers. They have driven nearly a 200x reduction in inferencing cost in just the last 2 years. And then one thing to really note is they're going beyond the data centers, and that's because every single autonomous vehicle company is developing on Nvidia chips. And then along with that, you also have sort of the call option that is robotics that really hasn't taken off yet, but I think when you take a look at other companies like Tesla, of course, with their humanoid robot, but also companies like Figure and Boston Dynamics, well, there's a lot of potential in robotics, not just from a consumer perspective, but I'd say more so from an enterprise perspective as well. So robotics is something that's really just beginning to take off. Of course, you have autonomous vehicles that's just beginning to take off. You're seeing that sort of build out in the data center. So this company is playing in many verticals. They have many secular trends sort of acting in their favor. And even when maybe data centers sort of tapers off on their growth rates, you might see that push towards AV or even robotics. And so keep those in mind. Nvidia has more than one just secular tailwind in its benefit. Now, the other thing that's probably a headwind for Nvidia is the fact that you have the Trump administration continuing to put chip curb controls as it relates to getting high-end chips into the country of China. Of course, that DeepSeek news came out a couple of weeks ago, spooked the entire market, basically showed the market that maybe you don't need a lot of Nvidia high-end GPUs to put up a very strong and compelling open source LLM model that performs relatively in line, maybe even better than some proprietary models that do use Nvidia GPUs. Well, first of all, some of that story may not have been fully true. Maybe they were still using Nvidia GPUs. Maybe they weren't just reported to the extent that they were using them. But look, I think it's fair to believe that moving forward, you might not need, or maybe not every company needs all the high-end Nvidia GPUs they can get their hands on. And so that's why that DeepSeek news certainly may have had validity to it. And as it relates to controlling those Nvidia chips flowing into China, well, then from the US's perspective, that could also make sense, because look, if China can do that with basically no Nvidia GPUs, we certainly, or maybe US certainly doesn't want them to get their hands on Nvidia's latest and greatest chips. And look, that also applies to other companies, again, in the chain like Lam Research, as well as ASML, Applied Materials. You can sort of go down the line. If Nvidia chips are being restricted into the country of China, well, then so will other semiconductor technologies that, again, have that really high intellectual property. And that can certainly continue to be a headwind for this company. Now, in my opinion, they have enough demand from sort of other parts of the world, especially from the US and Singapore, that they don't really need to worry about too many curb controls, at least at the current time. It's when demand begins to taper off, well, then having the ability to sell some chips into the country of China could be beneficial at that time. Now, from a financial perspective, look, we've covered this company a number of times here on the channel, and every time we look at it, it's basically hard to compare it on a year-over-year basis, but hey, we try nonetheless. Revenues went from 22 up to $39.3 billion. Again, good for 78% growth year over year. Now, what you are seeing though is the cost of those revenues, while they still remain really small, they are growing faster than your revenues, as those costs pretty much double year over year from 5.3 up to $10.6 billion. And look, when your cost of revenues grow faster than your top line, what that means is you'll see a hit on your gross margin. So despite the gross profit adding on nearly $12 billion, you're not nearly as profitable from a margin perspective. And so that's why you're seeing slippage on the gross margin side. For the full year, looks absolutely fantastic. 44.3 billion up to nearly $98 billion on gross profit. That is just fantastic margins. Again, despite the slight slippage, very strong margins. Now, from an operating perspective, just $2.5 billion of operating R&D expenses last year. That's up to 3.7. So still very controlled. And then your sales and G&A basically went from 700 million up to $1 billion. That's essentially a rounding error for this company. And keep in mind, look, these Nvidia GPUs pretty much sell themselves. They don't need a whole lot of sales and marketing, certainly, to sell out those Blackwell chips. And so you take this $28.7 billion worth of gross profit, you subtract out 4.7 in operating expenses, and you're left with $24 billion of operating income. That's for a quarter. You annualize that and you get to $81 billion of operating income. Again, fantastic, basically unrecognizable from a year ago for this company. And keep in mind, they're also earning huge amounts of interest now, considering the fact that their balance sheet is absolutely loaded to the sky. And you also see the shares outstanding continue to go down. This company executing on a very nice buyback. Now, speaking of the balance sheet, looks absolutely phenomenal. You went from $26 billion of cash last year to now sitting at $43.2 billion of cash on the balance sheet. So again, that's telling you why this company is earning more than $1 billion a year in terms of interest income. The other important things to pay attention to from Nvidia's balance sheet is the inventory line, as you went from $5 billion up to $10 billion in inventories. Now, normally for hardware companies, this could be seen as a bad sign, considering the fact that maybe they're not able to move on all of their inventory, and so they're sitting on some of that a little bit more. In the case of Nvidia, I actually think that's a good thing, considering the fact that demand continues to outstrip supply. Look, we know that's been the case for a while. We know that will continue to be the case, at least for the remainder of the year. And so if they're able to sort of manage their inventory a little bit better, they can perhaps look to meet that demand in full moving forward. Now, the other thing to pay attention to also is the property and equipment line that went from basically 3.9 up to $6.2 billion. Certainly we know Nvidia isn't the one manufacturing their chips, that sent over to TSMC, but they're still trying to invest a bit into property and equipment, at least aggressively trying to meet, again, those manufacturing demands that the hyperscalers are putting on this company. So from their asset side, things are looking good. They're trying to ramp up as demand continues to ramp up. And then from the liabilities, well, it looks absolutely phenomenal, as your long-term debt is basically flat year over year at $8.4 billion. You paid off your short-term debt. That was about $1 billion. So look, all things considered, they have $18 billion. In fact, look, $32 billion of total liabilities balanced off by, well, $43 billion of cash. And that's pretty much all you need to know and worry about with the balance sheet. Now, from a cash flow perspective, it couldn't get better, but it just did. Net income of $22 billion, again, for a quarterly basis. Stock-based comp is pretty much negligible, considering the fact that how much profits you're printing over at this company. And so nearly $16.6 billion of operating income for the full year. It's at nearly $64 billion. That's right, $64 billion of operating income. Last year, you were at just $29 billion, $28 billion of operating income. I mean, the way this company has grown basically tells you why shares are up nearly 66% over the past 1 year. In fact, that might be a bit low, considering the fact that you're looking at these numbers up well over 100% on a year-over-year basis. And then in terms of capex, they don't do as much as maybe Intel. Certainly they are still trying to ramp up and meet that manufacturing demands, and so they did spend nearly $1 billion on capex in the most recent quarter, which again was a bit, I'd say, aggressive compared to their full year spend of just $3.2 billion. And then they're pretty much left with about $15 billion of quarterly free cash flow. What they do with that is they pay back nearly $7.8 billion worth of the stock. So they did a nearly $8 billion buyback. They also pay a little bit in dividends, and while the rest, they sort of just buy into marketable securities to the tune of about $7 billion in the most recent quarter. And so on a cash basis, they're basically neutral in the most recent quarter, not really spending or earning a lot of cash onto their existing cash pile. So the CFO doing a really good job managing those cash flows, spending a bit on the buyback, spending a bit in marketable securities. Nvidia also tends to invest a little bit into some smaller AI companies out there. And so anytime you see an investment into them, they certainly have a little bit of equity and a little bit of skin in the game as it relates to the AI players in the field. So again, all things considered, the financials, fundamentals story looks absolutely stellar over at Nvidia, at least from the most recent quarter, most recent year. It's again how this company expects to close out the year in terms of revenue expectations. Like we talked about at the top, if they can come in closer to the high end of the range, near $55-60 billion in Q3, maybe $70 billion in Q4, well, then this company is wildly undervalued and you have lots and lots of room to the upside. But look, if they come in and just meet expectations, continue to be in line as the growth rates begin to slow, well, then you might continue to chop around sideways. Now, speaking of chopping around sideways, not necessarily a bad thing over at Nvidia, considering the absolute monster run you've made in shares. And so I've highlighted this green box. This is really the area where I would tend to get super interested and aggressive with shares of Nvidia. Anytime you can pull back into this green box, whether that's on any news such as DeepSeek scares or perhaps maybe just a broader market sell-off, well, then that's your buying opportunity. If you step in here underneath 110, really as low as maybe $100 or even $90, I think that's your chance to step in a bit more aggressively in shares of Nvidia. Anytime you come up here close to the 140s, you probably don't need to buy as aggressively. You can continue to certainly nibble into your position and continue to maybe hold or add incrementally as you can, if you push up. So certainly if you push up maybe close to 160, 170, if you make new all-time highs, well, then we'll certainly have to come back and reevaluate the stock from a valuation perspective. I'd say at the current time at 130, not certainly concerned from a valuation perspective, especially considering the fact that you're making a lot of sideways consolidation. So you're sort of just flagging out. But if you certainly push up to the 170s, 180s in a hurry, well, then that can be your chance to maybe take some profits considering the fact that, well, the growth rates are slipping, the gross margins are slipping, and eventually Nvidia will hit a downturn, probably maybe 2-3 years from now. And so while you likely have made the majority of your gains over the past 5 years, you might still have 1 or 2 maybe last pushes to the stock, maybe push it up as high as 180, 190 before it cools off yet again, as it tends to do since it's a cyclical environment, cyclical industry in general. That was my take on shares of Nvidia Corporation. I think a fantastic company. I think we all knew that. I think the guidance came in pretty much as expected, slightly better compared to the Wall Street number, but maybe not as high as expectations were internally with a $2 billion beat and $2 billion raise. I think you still have some upside left with shares, and considering the fact that the valuation isn't overly egregious, wouldn't be all too concerning to step in and be a buyer at these levels. But if you can get deeper pullbacks in the low 110s, maybe in the low 100s, that is your point to be aggressively stepping in to shares of Nvidia. Let me know your thoughts on this one in the comment section below. As always, thanks so much for listening, and I'll catch you guys in the next video.